My name is Charles Brown III, aka CB3. I'm a portfolio manager and financial educator, and I've been an investor for more than 30 years. As a portfolio manager, it's my job to keep our clients calm during difficult market periods. I did it in the crash of 2008. I did it in 2009 and 10 as a commentator for Fox News. And I did it in 2018 during the trade war scare. But 2020 was different. The pandemic brought a new intensity of uncertainty to all of us. When I began researching this week's show, I asked, how can I encourage them financially this week? How can I help them make their week more successful? That's why CB3 Live exists. We've been on 2 platforms in 2 cities with the goal of providing financial truth and a sense of calm about what's happening right now. Every week, I look forward to providing financial peace of mind to my clients and listeners. It's for this reason that it's a privilege every single time I start a broadcast by saying, from COVID, U.S. policy, and world economics to clarity. This is CB3 Live. Good evening, everyone. Live from Nashville. It's Thursday, January 13th. I'm Charles Brown, Portfolio Manager with CB3 Financial. Happy New Year to you. And I hope that this program gets your new year off to even a better start than you've already had. We're calling this What to Do in 22. It's already been a little bit of a rocky start to the market, as undoubtedly you have noticed. There's a lot of things going on. We have an election year. This is an off-election year. Obviously not a general election, but still a whole lot of things in play. And so we're going to talk about that. And of course, the ever-present discussion of inflation, which never really ends, at least it doesn't seem like it does. So if you're new to the program, please subscribe to us on YouTube. If you're watching us there, click the little bell and you'll get updates whenever we go live, or if we post one of our intra-month videos. We're on Facebook, we're on Twitter, of course. Those of you that subscribe see that I tweet every single day, sometimes more than once if there's something going on. And then, of course, we're on LinkedIn as well. Tell your friends. We'd love to have more viewers. So just kind of reviewing our order here. We always start the program with the monthly market review. That's what's going on, that's given us the results that we have in our portfolios. You guys know that I'm a money manager. Those of you that are clients, those of you that are viewers, you probably also know that too. We show our performance, which we'll show now through December 31st at the end of this module. And then I'll go into each of the different segments that talks about what I'm seeing going forward in 2022. So we have a booming U.S. economy, even with the market volatile right now, and it has been really since mid-December. But it's we're just doing well here, at least in comparison to the rest of the world. We're bringing in imports, straining global supply chains. Obviously, you know about the supply chain crisis that has been really in the world now for way more than a year. But that's what's pushing up prices. You're going to see a lot of people on corporate media trying to tell you that we are even possibly nearing a recession. I don't think anything could be further from the truth. And there are a lot of reasons for that, and we'll get to that in the inflation section. But basically, this American expansion is getting overseas companies to invest in the U.S. because they're betting that our growth is going to be stronger than theirs, that we will outpace the other major economies. U.S. consumers are flush with literally trillions of dollars of cash from the fiscal stimulus that we've gotten over the last 2 years. Hard to believe, next month it's 2 years since COVID began. And we've been buying all kinds of manufactured goods and scarce materials. And of course, that's what's causing inflation. We'll get to more of that, of course, in the next module. So U.S. economic output expected to expand to 7% when we get the full data on the fourth quarter of 2021. At least that's what the Federal Reserve is estimating. So why is the market so volatile this year? Selling begets selling. Panic begets panic. People watch the news, they get upset, they pull a trigger, they get out on the low of the market, and then the market moves up 400 points the next day. And I'm speaking about the Dow, obviously not the S&P. And it's that kind of volatility that we do see every single year, almost every single year. We did see a little bit of it last year. We're going to see more of it this year. I think there's no doubt in my mind that 22 will be a more volatile year than 21. We had a lot of lifetime highs hit, which we'll get into in just a few moments here, right on the screen actually. So if you see in blue, that's the number of closing all-time highs starting in 2013, which is when this bull market began. Now you would be right to point out that the low of the market, in fact, was March 9th, 2009, 673.56 in the S&P 500. All right, but the actual secular bull market did not begin until the market traded above the highs of April 10th, 2013, and we had 45 new highs that year, 53, 10, 18. Last year, 69 new highs, only exceeded by 1995. It doesn't feel like it right now when you see these big moves down, but again, that's recency bias. I've talked about recency bias for 2 years now, since these programs began 23 months ago. Okay, we are still in good shape in the long run for the secular bull market. If you break this down by the sectors, look at the green check marks. Look at the summary at the bottom if you don't want to read every number on the chart. New highs, 54%. New closing highs. Okay, so this is weekly data, meaning you could hit a high on Tuesday, but it wouldn't actually close on Friday. But the same percentage, and then 100% of the let's try this again. 100% of the 11 sectors are up, at least as of the end of December, because that's where we're charting the data here. So now this January barometer, a lot of people say, so however January goes is how the rest of the year goes. Well, look at the number of negative Januaries. And so far, January is negative in the S&P and certainly the NASDAQ. But the final 11 months, with the exception of 2008, which was a terrible year, have ended up being positive. So don't let how January ends cause you angst. We'll be back here in February talking about how January did end. But here's the data to show you that we can have an off or a tepid January and still do just fine for the rest of the year. These are your leaders for the year. This is closing data, so we are in a good deal of these: Microsoft, Apple, Google, Amazon, Tesla, You can see them here on the screen. Obviously, it gets very tiny as the smaller percentages cut through, but this was a year for the mega cap stocks to shine. And we had exposure there. I wish we had had more exposure there because we definitely underperformed. You'll see this on the screen. Our 3-year numbers are good, but this was a year of very strange, when I say this, I mean last year, 2021, very strange rotations in and out of different sectors. We did not see that in 2020. From the low of the pandemic on March 23rd, 2020 through the end of last year, well, the previous year, 2020, was pretty much straight up across the board in many sectors. Now, why are people investing in this country? You might have wondered that when you saw that slide 4 slides ago, and that's because look at China. How would you like to have invested in China last year? Down 20%. I get emails every once in a while saying, so I don't see any foreign investment. What's your thought on that? Well, I'm avoiding Asian markets for sure, like the plague, and I'm not really even that interested in European markets. We are firmly invested in the U.S. We do have a couple ADRs, American Depository Reserves, but we're really mostly invested in the U.S., and it's this chart that's the reason why. Okay, this is a chart you've seen many, many times. I bring this out, especially after we've had any kind of market volatility. This is a 100-year chart. The red squares represent secular bear markets. The long black lines represent secular bull markets, and we currently are in the third one in the last 100 years. The previous 2 ran over 20 years. If the same thing happens here, this is going till 2033. I do think that's possible. I really do. So I have highlighted in green here our 3 favorite sectors: technology, communications, and discretionary. They continue looking back since this bull market, secular bull, began. Again, April 10th, 2013. A lot of numbers here, guys. They are still our strong performers. Even with these downturns, remember, recency bias, just what's happened in the last 10 to 15 to 30 days doesn't mean that's the preponderance of the long-term view, because it is not. The long-term view remains secular bull market. Now, we're starting to get earnings reports. You know, we have this chart here. There's hardly anything to show you, but I do it every month. So far, we're right on target, or a little bit below target, I suppose. 73% is the norm for the last 15 years. We have 20 companies reporting out of 500, so it's hardly any data at all. But we're entering a new regime here. I think that unlike any time in the past century, or at least half century, I'm going to call it, we're going to see positive equity returns coupled with a down year for bonds. I continue to avoid bonds. Those of you that didn't watch my October show or September show where I did the segment on asset allocation, definitely should go back and watch that as to why I'm avoiding bonds. It's all right there. But this restart of economic activity it's amazing. Even though we continue to live in a medical crisis, we are not in a financial crisis. It's very important to distinguish now from 2008, 2009, which was a financial crisis. We are in a medical crisis, which does tend to weigh down the sentiment during the stock market moves, but it does not govern them. Okay, central banks will start to raise rates. I'm going to talk about that when we get to the Fed. We're going to see inflation, higher than we want to see it, but I've got comments on that in the inflation section. We continue to favor equities over fixed income. We have virtually no fixed income. There's a tiny bit of preferred stocks, which technically is fixed income, even though they're equities, in the GI program. But I think we have a wide possibility of outcomes in 2022. I do not believe this will be another slow and steady year like 2021 was. So here's our performance. I'm going to get a sip of water here, let you guys digest this screen. I'll check for questions. Notice that year to date and 1 year are exactly the same numbers, and that always happens when you take a snapshot of your performance on the last day of the year, right? So year to date, 1 year. 3 years, strategic growth moved up this year. It's actually exceeding the S&P on a 3-year basis. Capital growth still beating the S&P. On a 5-year basis. When you see the asterisk, that means that strategic growth will have a 5-year track record in another 2 years and 2 months. And then growth and income will have it, I think, in about 3 years. I'm not sure. But at any rate, I know that doesn't seem to make sense, right? 5 years and 3 years, but you have to go back and clean data from previous time frames. So I'm going to check the question board here and get a sip of water. And if you got questions, I know we're on a 25-second delay, but just ask away. All right. Well, if you guys change your mind and have something to ask, I'll be here. Okay. So the world economy, as I said, that's what we've done performance-wise. That's what's driven the returns. Everything here going forward is what I see as an outlook for 2022. Okay. Certainly the employment scenario, sometimes it's called the unemployment scenario or non-farm payrolls. I call it the employment scenario because it makes more sense. It's more comprehensive. The reason we do this program on the second Thursday of the month is because the first Friday of the month is when the employment scenario is released by the Labor Department. The unemployment rate dropped. It was expected to be 4.1%, 3.9%, which is a positive. The underemployment rate, now those of you that have watched my broadcasts and attended my live speeches for years know that I weigh both of these. U6 and U3 are the two different rates that are provided by the Labor Department. And these just continue to plummet. Now, you can't have a recession when unemployment is this low, okay? And we'll get to this later on. I'm going to show you some charts of what it was like during high inflation and the unemployment rates that ensued from that. But we do not have that scenario now. And in fact, there are so many job openings. The survey was for 11 million. The actual was about 10.5 million. So that's a little bit of a burp, but still 10.5 million job openings that cannot be filled. This has been the case really since shortly after the pandemic began, and it's going to have to even out. The recovery path, now this is the length of time it takes to get back to formerly the zero line, which was February of 2020. You can see the red line starting at 100 or zero. And there's where we are at December 2021, quarter three. We are expecting to be back to pre-COVID conditions. Now, we're still not where we were had COVID not happened, and that's because, as you know from my opinion, we should never have shut down this entire U.S. economy. And we're digging out still almost 2 years later. Next month will be 2 years. It's hard to believe, but I'll have more on this next month as we are 2 years into this, but I think we're actually doing quite well. So the job seen in the current and previous cycle, look at the 2020. You guys know for, I don't know, you've been watching however long here, the V-shaped correction. This happens in so many data series. So we have dramatically pulled out of what we're calling the Great Lockdown and Recovery. The blue line you see, look how long it took for 2008, 72 months. Look where we are just roughly 24 months into this. Okay, it'll be 24 months next month. All right, it's a great recovery effort on the U.S. economy. Again, you do not see this data in European and certainly not Asian countries. This is why we continue to almost entirely invest in the U.S. economy. Another way to look at this, unemployment, this is just a short time frame within 1 year. So look at this V shape again for 2020. Look at 2007. That's what happened prior to the 2008-2009 crash. All those little gray lines are other various shallow recessions. Okay, it didn't take them that long to recover. Look how deep this recovery has, look how deep the recession was, the economic downturn was, and how quickly it's recovered. This is the most remarkable and resilient data that I can show you. And this is why I continue to say, don't listen to what they say on the news, because this is the data from the Labor Department. Okay, National Bureau of Economic Research. This is strong data, folks. We're going to cross that zero line and get back on track way ahead of where we did in 2008, 2009. The biggest challenge we have, again, it's really hard to have a recession when people are quitting jobs. Recessions happen when people are standing in employment lines or unemployment lines trying to get a check or trying to get a job that there are just too many people for too few jobs. It's exactly the opposite. We have the highest quit rates in the history of America. 23% of workers will quit this year. Obviously, that's a visceral fact we don't know until the end of the year, but that's almost a quarter. 1 in 4 workers will quit. Why? They plan to work for somebody else. They plan to seek a new job, already have a new job, or they just plan to retire. Okay? Workers are not concerned and holding on to their job for dear life because they know it's very fluid and that the job market is plentiful out there. Again, those are not conditions you have heading into a recession. So why are they seeking new jobs? Either better pay and benefits, finding a job more passionate about, want to continue to work remotely. Number 4. At the very bottom, don't want to work remotely. So it looks to me like the culture in America is swinging around to saying, I really like this working at home. That's the data that I'm seeing. All right. So I think we're probably back to full employment. You don't have a 0 unemployment rate. It's just not possible. I've never seen one. There's always somebody that's unemployed. There's always some job that's out there. And when you get under 3%, at some point there are data skews or even rounding errors. But the Fed, who's what counts, thinks that full employment is around 2.5% to 3%. We're at 3.9. We're really close to that number right now. They're calling it 3.8 to 4.3. I think in the inside, the Fed would like to see it around 3.5, 3 to 3.5. Okay. So the takeaway from all of this on the employment side is the labor force participation rate, the number of people working, did increase slightly, but it did increase. And again, that's because so many people are quitting. If you have people getting new jobs, but then the quit rate stays high, it's hard to improve on the labor participation rate because you have so many people quitting. All right. Initial claims. This is just the number from yesterday. 43,000. The reason I put it here is because it's the lowest level since September 6, 1969. This is such a dichotomy. You have the number of claims dropping because, again, so many people that want jobs can find them, and there's so many jobs that are going unfilled. We have not had this situation since 1969. Seasonal factors have a lot to do with this. Obviously, at Christmas, we'll get data here the 1st of February, which I'll report to you next month. But here's the best example. This is kind of old news because it was 3 weeks ago, but I just find it astounding. Apple is giving significant stock bonuses. Can you say $130,000 to $180,000 to their engineers to keep them from quitting? $130,000 to $180,000. If you want more information on this, check it out at the Wall Street Journal or Bloomberg. Both of them covered the stories pretty well, but it's astounding. That's how much competition there is to keep workers. That is not a scenario for a recession. Okay, let me check here. Hey, Nellie. Florida recovered very strong. Yes, exactly, due to no shutdowns and great governor leadership. I know that Charles is very fond of Ron DeSantis, and I am too. So we are glad that he is there running that state. And you guys are doing great down there for sure. So inflation, everybody talks about inflation. Let's get to the heart of it and what really counts. So this was actually sent to me from one of our viewers. So the only reason I'm showing this is if you guys really want to understand inflation, if you want to dig into it beyond what I'm showing you, go to the U.S. Bureau of Labor Statistics. It's right here. You can find the URL. These are their stats. We did have a 0.5% increase in December, which was lower than November, though, 0.8. Okay, so here's why, and I'll get to this as we go through the slides. This is why I remain not concerned. I know you probably think I should be, and you see the spike on the screen. Inflation hit 7% trailing year. Now, that's the important part, a trailing year. So you add everything up over the last 12 months, and it's on the fastest pace since 1982. Well, of course it is, because there is so much demand and there's not enough product. There's even not enough product as far as people to work or actual hard goods. Now, we saw very low inflation rates in January, February, and March of 2021, which means when the new number comes out, which it did for December, it's going to come out January, February, March, we're going to have 3 more sky-high numbers. But after that, those low numbers from a year ago drop off because these data are always looking back a trailing year. By the time the higher numbers start coming in May and June, then the 1 year average is going to drop. And you're going to see that in the charts here. Here's one reason. Okay, this is California, but that's what people are paying for gasoline. Now, I realize that the policy section is coming up, but there's a reason for this. We used to have energy independence, and we don't now. We're asking OPEC to ship us oil, and when that happens, they're controlling the price. We had all the oil that we needed, okay? Pipelines got shut down January 21st, 2021, and you guys know the rest of the story, all right? So what is really pressing on inflation? Is it every category? No, it is not. It's energy, it's gasoline, it's natural gas. That's all energy, just spelled differently. Okay, look at apparel, food at home, food away from home. Medical care services actually are deflationary over the last year. I wouldn't have believed this if I hadn't found this from the Bureau of Labor Statistics. Thank you to our viewer, Tom, for showing that. You guys, if you want to dig into this and you wonder, how can that be right, Charlie? That's how it can be right. Because it's simply not all areas of the economy that are generating this inflation. All right, here's the data. Okay, let's go into a little more detail. This may be more than you want to see. Do a screenshot if I don't stay here long enough for you. But this is literally looking at every single month last year, December 21, January, February, March, etc. Okay, that really should be December 20 of 20, not 21, because December 21 is on the far side. You can see vehicles, parts, energy, etc. Those areas that I just mentioned in the previous slide, they're getting redder as we go forward in time. Look at energy costs. That's why that gasoline was $5.95. We're not paying that here in Tennessee. I don't know where you are. I'd be interested to know what gasoline is in South Dakota, for instance. Or if you want to type it in the chat, you can. I'd be interested to see. But notice that we just don't have dramatic inflation in every single sector across the board. That's what happened in the 80s. It's not happening here. Why? Because this is a demand-driven or supply dearth-driven inflation issue, okay? Now, we're getting to the point where some economists are going, this is crazy. We can look up ahead and see that this is not going to continue. So look at the blue line. You see the rise in inflation, okay, from 2020. Again, scarcity of goods. When you have too much money chasing too few goods, it creates inflation, all right? When that demand is satiated by supply coming online, by these boats being unloaded in Los Angeles and Long Beach, and we have stores that are shelved, shelves are full of supplies and cars in lots. Still have a situation here in Nashville. There's like one car on the lot in many of these dealerships. All right, but look at what the projection is here, down from 6.5%, 5.75%, 4%. And these bars are not on an annual basis. Look at the score at the bottom. This is on a quarterly basis. We are going to see this drop. This is temporary. I'm telling you, this is temporary. You cannot let this concern you. Yes, I know the PPI. Now, you guys know CPI, Consumer Price Index, PPI, Producer Price Index. Okay, so one's what the consumer pays, the other's what businesses pay. It's a high number, but it still was better than the consensus. All right, the monthly change was half of what was expected. Obviously, Omicron is still affecting airlines and other parts of the economy, but this is temporary. It's just plain temporary. US CPI skyrocketing. I get it. Notice that it did it back in 1987. If this chart went all the way back to 80, you'd see it high there, but it doesn't stick around for years at a time. All right? So why is this 7% inflation today far different than roughly the same conditions in 82? You see the people here waiting on the job line? Because in 82, that was the beginning of a bear market situation, people out of work, super high inflation that lasted for several years. And the Federal Reserve had to step in and just keep cranking interest rates. You remember, we joke about this often that, you might have gotten a CD for 11%, which is wonderful, but then your mortgage is 14.5%. We haven't seen any numbers like that in 40 years, and we are not headed there, folks. We're not. I'll check the chat real quick. $2.99 a gallon. Thank you, Debbie. And Kay. Okay, good. Moved. So, inflation, guys, rather than looking at 82, let's look at two different time frames here. Now, again, why am I doing this? I've shown you the performance. I've shown you what got us to what we had last year, but 3 and 5 year trailing returns, analyzing data during those time frames to outperform the S&P. That's what you pay us to do. That's what we do. What we do going forward in these next segments is talking about what could get in the way of continuing to have those kinds of returns. And inflation certainly is one of them, but I'm looking at a data point that says where we are right now really is more fairly compared to a 1946 or a 1973. 1946, end of the war, massive demand. Massive demand. Industries had been retooled to produce warcraft, metal parts, bombs, munitions, whatever else. And they had to be retooled to go back to their normal delivery products, okay? And during that time, there was way too much demand and not enough supply, so inflation ensued, and then it backed off. Same thing happened in 1973, year I graduated from high school, and then just came right back. Inflation of 20% in 1947, falling all the way back. I mean, we do have these short periods, and they're demand-driven. They also can be job killing like happened in the early 80s. That is not the situation that we are in now. We can't find enough people to work. I would love to drop this section. Guys, but it just won't go away. Look at this spike. I got to get a drink here, but I don't know what to say. I thought that you see the second bump there, in last summer, and I thought we would just continue to dwindle down to nothing, but but that's not the case. The reality is that that this Omicron has just turned out to be. I just got a call literally 20 minutes before I went live. I got COVID. Just letting you know because we were together, sort of, a few days earlier. But this number is high. 2-week trend up 160 almost %. The death trend, however, continues to not exceed the previous death trend. And I think there's two reasons for that. The number of people being vaccinated and because Omicron, certainly we all know, doesn't seem to be quite as lethal or anywhere close to as lethal. So Boris Johnson, Premier in Great Britain, says he believes it's peaked there and the cases are declining, hospital admissions are starting to fall, and the trends are generally optimistic. And he hopes the whole pandemic is receding for good in England because they're kind of ahead of us over there. It comes this way. I'm hoping that that's a trend that continues here in the U.S. I think it could be. So you saw a similar chart for jobs. This is actually the current recovery in terms of COVID lockdown and recovery versus the Great Recession and recovery. Again, I can't try to quantify the medical and humanitarian losses. That's not what I do. I analyze the markets. But 2020 lockdown, guys, look at this recovery. This is just a bodacious V-shaped recovery here for this lockdown. And it comes for a lot of reasons. People changing jobs. We did have a ton of physical stimulus. And people have been spending, and they're continuing to spend. It was a very different situation in 2008. I'm encouraged. This trajectory is going the way it needs to go. This is going to upset the vaxxers on the line, or anti-vaxxers, I should say. I'm sorry, but New England Journal just had 2 days ago. The Pfizer shot is basically preventing a whole lot of ICU visits, 94% of COVID-related hospitalizations, 99% of COVID-related deaths, which means 1 out of every 100 people that goes to a hospital that dies has been vaccinated. And there's always going to be somebody out there in the 3rd or 4th standard deviation. But in general, the vaccines are working. I mean, that's just the data that we're seeing. So this COVID inflation surge happened. You can see it on the chart here. It wound down from the previous decade, 2010, all the way into 2020, and then has just spiked since then. Again, it's demand driven. It's not because companies are not able to produce goods that people don't want to buy. They're not able to produce goods that people are, shouldn't say dying to buy, but are really, really pepped up to buy. All right. That's what makes this time different. U.S. companies continue to thrive despite this pandemic or even because of it. So revenues, profit margins, you'll see more of this in the economic data coming up. But their sales are higher. The liquidity crunch that many thought would happen, meaning companies literally didn't have enough liquidity, banks wouldn't have been loaning them money. None of this happened. Pretty much the whole financial industry just kept humming right along because people realized, again, even with some recency bias, that this was a financial crisis, not an economic crisis. I know I've said this so many times, but you just have to totally take that in and make it part of your belief system. We are going through a very difficult health crisis, and people are being lost, and it's tragic. But it's on the financial side, it is nothing close to what 2008, 2009 was. We cannot stop the spread of COVID, but we can end the pandemic. We can end the pandemic by not letting this country shut down like it did a year ago or a year and a half ago. And I think you're seeing that, certainly in some states. You're not seeing entire states shutting down, at least not in this part of the country where I live. Politics, why is it important? Because politics leads to policy. Policy drives portfolio impact. That's why we have this segment. So, as I mentioned at the very beginning of the broadcast, we are in an election year. It's an off-year election, meaning no presidential election, of course, but many senators, exactly 1/3 of them actually, and everyone in the House of Representatives has to run every 2 years. So because of the redistricting, and again, this happened in 2020, there's a census taken every 10 years, and the redistricting, which was mostly in control by the Republican Party at the local level, this isn't done at the federal level, the redistricting has favored the Republicans. So you can see the green line that says safe for Republicans, competitive now, way over to the left, safe Democratic, leaning Democratic, much smaller bars than they were before the redistricting. Why do I mention this? Why does it sound just partisan? It's not partisan. It's because how people legislate affects how businesses work. And for the most part, conservatives are pro-business, and they create legislation that helps businesses. If businesses are being helped, they make more widgets and more profits. If they make more profits and we own their stock, we participate. It's just that simple. This is really interesting to me. The net domestic migration. Okay, you've heard about it. You might have seen people talk about it. This is from the Census Bureau, the U.S. Census Bureau. This is real data. What do you see about the states on the top? A certain color come to mind, maybe? These are the states that are having massive inflows. I'm sure, Charles, you will not be surprised, Charles Todd, to see Florida at the top, and Texas, Arizona, North Carolina, Tennessee. Okay, every single state there. And on the bottom, with the exception of Louisiana, which is almost totally dominated by New Orleans politics, outbound. Guys, there is a huge emigration happening within the borders of the United States. I don't have the exact reasons for it. Some of it could be weather. Some of it could be politics. Some of it could be taxes. Could be all the above in somebody's case that I know. But you need to be aware of this because it affects eventually the House of Representatives and which states have more representatives and which votes, etc. I mean, it's a complicated process, but it does affect how legislation will happen going forward. You hear the line that, eventually people leave California, but they're always going back. Not so much. Exits to other states, 260,000 people. Entrances from other states, a little over 100. There is a massive emigration happening in the most populous state in the country. The 5th largest economy in the world is California. I don't know how much longer it's going to stay, but that's what it is right now. They're leaving. This is one of the reasons, and I'm sorry this is the only partisan thing, well, almost, that I'm putting on the screen tonight. When our president says we didn't have the vaccine and that here he is receiving the vaccine clearly, and just, after getting in office says we didn't have it, we clearly did. All right. This is what is driving these approval numbers. If you look at Joe Biden versus Donald Trump, they both started pretty strong. And then actually, if you look at the current numbers, you'll see the blue line, which is Trump versus Biden. This isn't current comparing them. This is how they had an approval rating at a certain time in their tenure. Okay. Now, the bottom graph is the approval index, and you can see clearly, Biden's down to about 21%. Now, this isn't anything to do with Donald Trump. It's just saying that people are upset with policies. And they're wondering what, is going on in Washington and how these policies are helping us. Again, I'm not making social commentary here. I understand that the Democratic Party is more interested in social change, social equity. But our show is about financial factors that affect our portfolios. That's what we do. And so this disparity that you're seeing in this approval index is pretty strong, to the point where Rasmussen, which is the only polling firm in 2016, November 2016, that called Trump would win the presidential race over Hillary Clinton. The only one. If the election were held today, Trump beats Biden 46-40. A whole lot can happen between now and November 2024. Neither candidate neither person has, announced that they're going to run or run again. And we'll see, but that's where it is today. Okay. Venezuela, in case you missed this slide last time, this is my concern with focusing so much on social change rather than financial matters. When Bernie Sanders is saying he's praising Venezuela, I showed this last time. I won't spend as much time on it this time as I did in the December episode. But we're just one generation away, folks. We need to be financially and militarily strong because we are the only superpower left in the world. The rest of the world doesn't have the vaccine. You saw the Chinese recovery. I could have put Europe's stock markets and France and England. Now, they're not as bad as China, but no one's outperforming the U.S. right now, certainly on a 5-year basis. Okay, and part of the reason is they don't have the economic freedoms, they don't have the economic engine, and the incredible innovation. We put this virus vaccine together in less than a year. The normal time frame for that is 3 to 4 years. Whether you like the guy or not, maybe they just, got paid a ton of money, but those American drug companies really came through. So this is where we are. All right, I think that the current Congress is living in fantasy land. Okay. I showed that to Alice and she said, you have to read that on the air. So get it? Fantasyland, Fantaxyland. Sorry, that's my first bad joke for 2022. But taxing our way to prosperity does not work. I don't want it for you. I don't want it for U.S. business. I want to see U.S. businesses prosper because when they prosper, I prosper. When I prosper, you guys prosper. That are at least having your money managed by me, okay? Our current administration and Congress is living in fantasy land and thinking that they can get to happiness and bliss with taxes. Can't happen. That's why I have this segment. Economic indicators, there's some good ones, there's some bad ones. We need to look at all of them, okay? Or as many as we think, or at least I think, that are relevant. So what's the biggest risk to my main scenario? My main scenario is we're going to be fine. Inflation is going to bump up. It's going to come back. What's the biggest risk to this? All right. Tapering or a policy mistake. So this is where Jay Powell has to get it right. And Jay has a section coming up here in just a little bit. Runaway inflation, okay, that are related. Pandemic, new variants. But notice how low that is. Everybody's really focusing now. Not everybody, but most of the population is focusing on inflation or tapering and Fed policy mistakes, okay? Chinese economic slowdown, I'm sorry, but that's just not up there for me. I'm with those on the left-hand side, but I think we're going to be fine, but I wanted you to see that. Another risk we have is population growth. We had the slowest population growth in 2021, 0.1%. We literally added under 400,000 people because, and again, the year goes July 1 to June 30. So total population, about 332 million. Just not what it's been in the past. Now, did we have more deaths last year? Maybe a little bit. but not enough to offset. People are just making different decisions. And this will affect the economic prosperity of the country if we don't grow. Without a doubt, the only reason that China is just not a footnote in the world economy is because they have so many people. Because if they do get their act together and really start creating GDP per person anywhere close to equivalent to what we have in the U.S., they will definitely be a force to be reckoned with, but they haven't figured out how to do it. Obviously, because you saw the chart on their stock market, okay? So our population growth has averaged more than 2 million a year, but yet birth rates continue to fall. Last year, again, the worst year. I don't think this is a trend. I have one child who is going in to deliver her fifth baby. I'm pleased to say it'll be our eighth grandchild, and then another daughter. Sorry to be throwing this out, but we're doing our best on the Brown side here to grow the population here. So, all right, TSA checkpoints. This is good data as well. We are now way exceeding where we were in 2020. 2021, still not where 2019 was, but look how close it's getting. People are having the courage to say, look, I might get sick from Omicron, but I'm not going to die from it, or likely not going to. And so they're flying. That's a good data point. Amazon shipping stuff like crazy. I don't know about you, but there are more Amazon trucks than there are McDonald's and Dunkin' Donuts together. Everywhere you look on the highway, they're out there. And that's because people are ordering stuff because their consumer sentiment is high. Small businesses with positions not able to fill. At some point, this is going to get, if this number doesn't come down, then it is definitely an inflation risk in the long term. It's hard for me to believe that jobs can go unfilled for more than another year or half a year even, maybe 18 months. Because they're just here, take this job, take this benefit. They're offering crazy rates. I've used the example of my daughter in Boston who has a nanny agency. They're offering nannies $100,000 jobs, okay, with benefits and 4 weeks vacation, and still can't get them until you bump it to 120. It's just crazy. All right. Here we are with Jay Powell. I'm going to take another break. What did I miss? Okay. All right. Any questions, anybody, about anything? A quiet night here. I see Deb signed off. Sorry about that. But all right. So the Fed, well, Jay Powell, here's the smile on his face. But above that, there's the consternation on his face. All right. And that's before he was interviewed by the House Ways and Means, and basically, to get reappointed. He was reappointed by Biden, but he has to be revoted on. So he's happy now because he had a real good interview this past Tuesday. So as I watched it, and I didn't listen to everything, but it appeared to me that the chairman was trying to keep three things alive. His job, American-style capitalism, that's good. Okay, and the stock market rally, that's good too, Jay. Please do that. I think he succeeded at all three. We had a really good day in the market, although today was certainly not a good day. But it's Mercuric. It's just going to be that way. He took a lot of incoming hard questions from people from both parties. So this is what many people are projecting is going to be the higher rates. Now, these bars look big and overwhelming here, but notice that the top number is only 2%. Okay, only 2%. 2% is a very reasonable Fed funds rate. We just haven't been there in a long time. But when the average is more like 5.5 over the last 60 to 70 years, I'm not concerned about that at all. Probability of 4 Fed rate hikes. This is not in my camp. I do not believe this is going to happen. I expect 3 in 2022 this year and 4 next year. I expect them all to be a quarter point. I do not expect that this is going to be anything near 4.5 to 5%. I think if you do it in quarter point increments, 0.5, 0.75, 1, 1.25, that the market will adjust to that. They'll be prepared for it, and there will be no shakeup in the market per se. So some of the key comments, I don't know why he does this. Inflation has nothing to do with tightness in the labor market. Really? That's crazy. That was a political statement. It was a shocker to me that he said that. You guys remember John McEnroe? You can't be serious. Whenever the official called a bad call, on the tennis match there he was playing, I don't think he's serious. He can't be, because obviously higher wages and not enough people to work too many jobs that are open is definitely causing the inflation. And certainly this has to change. More people need to come into the job market. And frankly, employers are going to need to raise what they're paying. I think you're going to see a compression between those at the highest C-suite, if you will, CEO, CFO, to the everyday worker. You're going to see that, maybe not a huge move, but compressing, getting closer together, because workers, for the first time in my lifetime, have a much higher ability to negotiate than they have at any other time I can remember. Okay. So I think it's probably the same as saying it's not transitory. If you look at the bottom, I still believe it's transitory. And the number one reason that I believe this on the camera here, guys, is because gold isn't budging. Gold's not over 2,000. It's not over 2,500. It's not moving. If the big, deep-pocketed players thought that there was an inflation risk, then they would be buying gold. And they're not doing it. The yield on the 10-year would be going crazy, and it's not. So the deep pocket players do not believe we have long-term inflation. I'm trying to give you a sense of confidence on that. In the crypto corner, this is a simple one, just one slide tonight, because I've got kind of a major announcement for you. Look at this performance over 1 year, Bitcoin versus crude oil versus the S&P 500. Now, the S&P had a good year, about 22 or 28.8, I think is what the return was on the S&P. Bitcoin much higher than that, but look at the incredible volatility, including halfway through the year, it was back to unchanged almost, the gray line there. So I've been talking about crypto on this program for quite some time, but I want you to know I'm going to trim my coverage of crypto because I think that this is going to be a very challenging year in the market, more so than the last couple years. So I am actually hiring, or I'm going to what's called a private investment fund for most of my own crypto investing. I'll tell you more about this in the next month's show because I actually need to be partnered with them before I can say anything. It is a private investment firm. They've got a great track record. And I just think it's time, at least because of this kind of volatility, it's just not something I want to do. I know some of you are really interested. I get calls every month from someone, either a repeat call or a new call saying, hey, I really want to talk about crypto. I think at this point you need to think about at least outsourcing to someone that does this all the time. Housing market continuing strong. Guys, look at the housing starts reverting back to pre-COVID trend. The dotted green line is the pre-COVID trend. Single family jetted up. It's now pulling back to the mean there. But it just continues to be strong because people are moving. Why are people moving? Well, you saw the charts earlier. Okay. It's just really encouraging if you own property in a part of the country now where it's rapidly appreciating. And that's actually more than just the either southern states or the red states. It's all over America. But this is positive. It's the largest area of consumer discretionary spending. And so we want to see housing, of course, always be strong. U.S. home price expectations. This is a new chart. I've never shown you this. I actually didn't know about this Pulsenomics until I just recently subscribed to them. But look at the pre-bubble trend. Look at the blue down there. I'm pointing to it because I can't use my red pen here. A 3.6% average annual growth in that blue line. But now what's expected going forward, look on the right side. The average is an appreciation of about 26.7%. On the low side, 14.8%. The high side, 38%. In Brentwood, Tennessee last year, we saw appreciations in the 30 to 38% range. It's just amazing. Will this continue? It will not. Will there be another bubble at some point and there be a correction? There will be. But this is This is very positive right now. It's really difficult if you're buying, but if you own property or you want to sell and, maybe live in a tent, this is a great time to do it. All right, guys. Well, so tonight we talked about what are we doing in 2022, the monthly review, world economy, employment scenario, inflation, COVID, U.S. policy, economic indicators, the Fed, crypto, housing market. And that's pretty much going to be the format for our shows going forward this year. I think that's a good format. And let me know if you guys like it, if it makes sense. Okay, so when do I see a meltdown in the debt market? That's a good question, Charles. Great question. There's nowhere for the debt market to go but down. A meltdown would mean, of course, that we see high interest rates in the 10-year and the 30-year. That would imply 5 to 7%. That's a ways off. There's still a certain portion of the investing market, and the bond market is bigger than the stock market, that must invest in fixed income maturities. For instance, those that do mortgages, to hedge with that, they're investing in treasuries. So they're investing in fixed income markets. And so there's just a really high demand, even though it makes no sense to me on an inflation adjusted basis why anyone would want to invest in fixed income. But I hope that answers your question. I don't see it anytime soon. I don't see it this year. Over time, you're going to see the bond market go back to, in the 10-year, probably 5 to 6%, and maybe stay there for a while. So our next show, guys, Thursday, the 10th of February. And just always end with this. I'm going to continue to end with this this year. From 2 Timothy, for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. I remain optimistic for the year. I remain optimistic for America. I remain optimistic for our portfolios and for you guys, okay? Thanks for the nice comment there, Keith. I appreciate it. But guys, anytime you've got questions, CB3 at cb3.com, easy to find. Tell your friends, trying to bring you good, honest information, well supported, well documented, well footnoted, so you can trust it. And if you can trust it and you can believe it, then you're going to sleep easier than you will watching the national media. Okay? We'll be here for you. If there are any updates that need to happen, watch for the CB3 Live updates that come out between my monthly shows. And thank you, Inova. Appreciate that. I'd like you guys to remember that at CB3 Financial Group, we don't just manage your money. We don't just manage your assets. We become one of your assets. Hope you guys have a great rest of the month. Stay warm. We'll see you in February.